Thank you for joining our meeting today. Today we have a very special guest, and the topic is 2022 real estate outlook. My name is Jenny Ching with KW Commercial, and I'm also your chair for Education Committee. So next we're going to have Pauline Lang to introduce our speaker today, Oscar Wei. Thank you.
Good morning, everyone. Welcome you joining today's class 2022 Real Estate Outlook. And I have very great honor to introduce you our very special speaker today, Oscar Wei. Oscar, you're the third time in our Zoom meeting since pandemic, right? Yes, and Oscar Wei is the Deputy Chief Economist at the California Association of Realtors. He co-manages the research and economic department and oversees the operation of the data analytics and survey research within the division. As an economist at CAR, Oscar provides regular updates on the economy, state, and regional housing markets, consumer behaviors, and public policy issues. He has written articles and reports on subjects including housing supply, affordability, mortgage finance, home ownership, tax reform, and other topics related to the real estate industry. He contributes frequently to the CAR Weekly Housing Market Updates newsletter, Housing Matter podcast, and Housing Perspective. His work has been quoted in the Los Angeles Times, San Francisco Chronicles, Kiplinger's, NPR, KFI, as well as other media outlets. Oscar has been with CAR since 2003. Oscar has a bachelor's degree in the economics from the UC Berkeley and a master's degree in economics from the Cal Poly Pomona. Well, now, please help me to give a very, very warm welcome to our special speaker, Mr. Oscar Wei. Oscar, the floor is yours.
Thank you, Pauline, for the introductions. Thank you, everyone, for inviting me to be the speaker. It's a great honor to be here to share information with you guys. It's not my first time being with the West and Gabriel Valley Realtors, so I'm always glad to be back to share information. Now, I do have, like usual, a PowerPoint presentation that I want to share. Give me a second, let me pull that up, and I will be sending the presentation to Pauline and to Fong later on after the presentation, and feel free to share that with the audience. Let me pull this up first. Let's get started. Give me a second. Here we go. You guys can see my PowerPoint, right? Perfect, perfect. So we are in 2022 already. It's been what, 6 weeks since the beginning of the year in 2022, and we have had some interesting things that happened in the last few weeks. We have ups and downs in some of the interest rates, and interest rates actually have gone up quite a bit since the beginning of the year. We are currently in we have a Russia-Ukraine conflict. I'll talk a little bit about that. There have been in housing market, I think so far has been doing okay, depending on what area you're in. It's not as high as, or the demand is not as high as what we have seen, let's say in a year ago or even a few months ago. But there have been it's been pretty solid, to a certain extent, but there are issues. So what we're going to talk about in the next 15 minutes or so, and we'll wait until the end for the Q&A if that's okay with everyone. But we'll first talk about the housing market. I'll first give you a 15-20 minutes update on how the market has been doing in terms of demand, in terms of price, and of course in terms of supply. We all know that supply has been very, very tight, continue to be a challenge, not only for realtors, but of course for buyers as well. And then that one of the reasons why prices have been going up for many areas. In fact, last year we had the statewide median price up by about 20%. So we're going to talk about that for the last, for the next 15, 20 minutes or so. But then, of course, housing market has a lot to do with the general economic environment. So we'll definitely segue into talking about, how the economy is doing. Yeah, I'm an economist, so I definitely have to talk about the economy. We'll talk about what's going on with, the market, the economic impact with the Russia-Ukraine conflict. We'll talk about the COVID situation. We'll talk about, how the economy has been doing and what we expect the economy to be doing in the next few months or so. We'll talk about inflation and about the supply constraint, the supply shortage in the labor market, as well as the material and equipment, and how that could affect, business decisions. And the very last 15, 20 minutes, we'll combine everything, the updates as well as the economic big picture. We'll combine everything and talk a little bit about what we can expect in the next few months and in the year 2022, and maybe a little bit, further over to 2023 as well. So let's take a look first at, the update. We just released our statewide number last week. Some of you might have already seen those numbers. Now here is a sort of a refresh of the numbers that we released last week. We released the January's number. We will be releasing February's number in a few weeks. Usually it's about 2 weeks after the end of the month. So the February numbers will not be available until maybe March. But let's take a look at the January's numbers. Let's see how our state number, our state housing market has kicked off, the year. Now, if you look at this number, we have sales right here, sales of existing single family home. We have price, we have inventory, and we have time on market. Now, the sales number shows a red number, a negative number. Now that, of course, every time you see a red number, that's not the most positive sign. But if you remember how the market has been performing, the negative 8.3% that we're seeing here is not exactly a surprise. At the end of 2020, or the second half of 2020, we actually had a pretty robust year, the second half of the year. We actually ended the year of 2020 with a record high for the last 15 years. We were at 510. Now, the beginning of 2021, it slowed down a little bit, but we still registered a 484,000. And that actually is a very, very high level number. Pre-pandemic, we averaged maybe about 410 and 20. So with that in mind, if you look at the number that we reported at the beginning of this year, 444 is actually not a bad number. In fact, even with 8.3% decline, it's still about the pre-pandemic level. I'll show you some slides later on how that number compared to the historical figure. If you look at the number at the bottom here, what are prices? Prices actually have been doing pretty well too. Since maybe about 18, 19 months ago, we have been actually increasing in price in the statewide median price by double digit. Take a look at this number. This number actually dipped slightly below 10%, but it's still increasing at 9.4%. So the statewide median price is still at above 765. That's actually not a bad number. Of course, it's not the highest. We actually have been showing some decline because of seasonality. It's not a surprise. During the holiday season, we always see some slowdown in price. But that actually is a pretty decent number at 9.4. And partly it is because of inventory. Now, inventory has already improved slightly compared to the end of last year, or the summer season or the buying season. It is actually now at 1.8. December and November, it was around 1.2, 1.3 months of inventory. So we have improved a little bit. Now, part of that improvement is because of some slowdown in sales. Part of it is because of supply. But let's take a closer look at some of those numbers, and let's see if we can make some sense out of it. If you look at the numbers here, the January 2022 numbers at the very, very end right here, and you can see, compared to the historical figure, yes, we are Definitely not as high as what we were at a year, 13, 14 months ago when we were at 510. But look at how it compares to some of these other numbers in the past few years, going back to 2009. It was actually pretty high compared to the last 2 years. And for a couple of reasons. Interest rates had been at a very low level, even with the increase that we have been experiencing in the last few weeks at around 4.10, 4.125. That actually is still a pretty decent rate compared to what we had in 05, 06. And remember, 05, 06, we had about a 6% interest rate, 30-year fixed rate. So it's still pretty decent. But of course, compared to the last 12 months or so, it is a little higher. The other reason for why we're seeing quite a bit of demand in housing is because of the flexibility of being able to work from home. Employers allow employees to work from home. Not every single employer, but many employees are allowed to work from home. Maybe go to work for a couple of days a week or so. That provides some flexibility of people to buy a home a little bit further away from their office. Gives them a little bit more flexibility. That allows people to have the ability to use their finance a little bit more smartly. Now, not every single price segment actually have been improving in terms of sales. You can take a look at this price, the breakdown in sales of existing single-family homes. You might have seen this before from my PowerPoint. On the left-hand side here, it shows sales, I guess, compared to a year ago in terms of the number of units sold. The lower price segments have been struggling, and it has been struggling for a year now because of affordability, because of tight supply. Typically, the most affordable segments are the segments with the tightest supply. Look at the highest price segment. Even the highest price segment started slowing a little bit, except for the 2 million plus. The million to 2 million is actually dipped slightly by -1%, and the 750 to 999 actually increased by 3. Now, a few months ago, in say June, July, these three numbers were double-digit improvement, double-digit growth. So yes, we're slowing down a little bit, but it's expected. Again, partly because of increase in interest rate, but partly because of tight supply. That has some, the slowdown in individual price segments also might have some implications on price. And I'll explain that a little bit more, in the next few 10, 15 minutes or so. Now, the slowdown in sales in the individual price segments makes up the overall decline of 8.3% that I showed you earlier. So it does look like that we're seeing some slowdown in sales going into the year as compared to the previous year. But as I said, it's still not a bad level. It's actually a pretty decent level as compared to the pre-pandemic. What about going forward? If you look at open escrow sales, look at pending sales, it does suggest that we are going to continue to see some slowdown. Now, this open escrow sales might account for some of the effect from the increase in interest rates that we have been seeing in the last few weeks. Now, we're currently, I haven't looked at today's number, but the 30-year fixed rate reported by Freddie Mac's number last Thursday, was 3.92. And I assume that number will probably climb up a little bit. So that might actually slow some sales down, but I don't think it's going to slow it down significantly. Part of the reason is when people started seeing rates start going up, they realized that it may not actually come back down, and they rushed into the market. The other factor that might actually restrict some sales could be, supply. Supply has been pretty tight, as I mentioned. If you take a look at this trend line going back to 2019, way back at the beginning of 2019, at the beginning of the year, we had 4.5 months. Look at how many months of inventory we have right now, 1.8. So it has been declining because of the pandemic, because of the more demand on housing, because of demographics maybe. So we have been seeing some slowdown and some tightening in inventory, but at the end of last year, we did start seeing a little bit of bounce back. Whether that bounce back will continue, that's hard to say. But based on the active listings number that we have seen so far on a monthly basis, take a look at this last segment right here. Now, this is January 2022, and you can see that it's actually started bouncing back. Usually at the end of the year, we always have a seasonal decline every single year. So this is not a surprise, but we are seeing a little bit of an improvement at the beginning of the year. Not much though. It's only inched up slightly from December. And you can take a closer look at the new added listings. New active listings actually, when compared to last year, was not as solid. It actually dipped. But yeah, and you can see how much it has declined. The dip here though, even though it is a drop and it's still a double digit, it is actually a slighter decline compared to the last couple months. It actually dipped by 11% as compared to, before then was about 15%, 16% or so. So we are maybe seeing some improvement. Now, what happened when you have a very tight supply and when you have enough demand? When you have very tight supply, what's happening is you create a very competitive environment. Take a look at the market environment right now. If you look at the survey statistics that we collect on a yearly basis, take a look at the number of the percent of sales with multiple offer. 71% of all homes sold received multiple offer last year, and the number of the average number of multiple offer is about 5.5, 5.5. You can see the last time we had that many or that big of share of multiple offer was back in 2013. Remember what happened in 2013? 2013, home prices actually dipped to a level that is right around 400-ish or so for the statewide median price. How much is the median price right now? Right around 800. So much higher median price right now, but the market is still very, very competitive. Part of it is because of interest rates, very low interest rates. Now, look at it on the right-hand side as well. This chart shows you the percent of homes sold with a price above asking price. And you can see how it compares to previous years, 17, 18, 19. The peak of the number of homes sold with a price above asking is right around 40. And at the beginning of this year, we are at 57, 58%. And at the peak, we were at 71. So you can see that the market is still very, very competitive right now, even though it is considered slow season. And of course, properties or listings have been flying off the shelf really quick because of the competitiveness. It's only staying in the market for a little bit over a week. It is actually already an improvement compared to a year ago, because a year ago, it's even more competitive. So what happened when you have a lot of competitiveness? Well, your clients, depending on whether he or she is a seller or a buyer, for a seller, they would be, very happy because now their house can be sold on the market for a higher price. But as a buyer, that's going to be tough. Now take a look at this price charts right here. Competition push up home prices, and I showed you a snapshot earlier. The January's numbers statewide. This existing single-family homes only, doesn't include any condos, was at 766. On a month-to-month basis, it's actually dipped a little bit compared to December, but when you compare it to a year ago, it's still an improvement of 9.4%. That's pretty impressive. But I do have to tell you, we have been actually increasing at a double-digit rate until this month. The first month of this year actually dipped below 10%. And part of it, again, is because of seasonality. Usually at a seasonal, at the beginning of the year, we have some seasonal slowdown. But I think, the fact that we are seeing, increase in interest rates may be part of the reason. Take a look at the comparison between interest rate, 30-year fixed rate at the beginning of this year and a year ago. you can see there is a difference of close to 70 basis points, 71 basis point. It's not a small amount. If you look at 71 basis point, and if you apply that to the median price home, you're looking at the difference here. This is a percent change from a year ago in terms of mortgage payment. It increased by about 18, 19%, pretty significant. That and then of course interest rates actually have been rising even further in the last couple of weeks or so. You can see from the chart here, mortgage rates, I think, depending on which one you look at, the orange line is the Freddie Mac's number, which arrived at 3.92 last week. But look at the blue line. The blue line is the line that shows you the mortgage news daily number. That number actually has gotten above 4% already. I think it's 4.1, 4.2 right now. It dipped a little bit last week, and it started coming back to a higher level. So you can see that mortgage rates will likely continue to stay at a high level. Now, I don't think it will climb at a fast rate like what we saw in the last couple of weeks. Part of it is because of the ongoing turmoil with in Russia and Ukraine that might actually concern people a little bit, and it may actually slow down the inflation rate a little bit. But if you look at the timing of the rate hikes, this is a chart put together by ING, and it shows different central banks. The Federal Reserve is our central bank, European, the ECB, and Bank of Japan, and so on and so forth. It shows you how many times they expect the central banks to raise rates. If you look at the Federal Reserve, it is expected to raise rates about 5 times this year. And 5 times this year, before the end of the year, it is going to do some quantitative easing and things like that. Now, 5 times, if it's raised 25 basis point each time, that means 125 basis point. I think some of those increase in interest rates that we have been seeing have already priced in some of the rate increase, or Fed funds rate increase. That's why it has been rising. The question is whether it is going to stick with 5, whether this prediction is right, whether it is going to increase a little bit more. Now, JP Morgan actually came up with an assessment saying that it might actually raise rates by 7 times. Now, whether I didn't look into it to see whether it means 7 times this year or 7 times between now and maybe 2023. But the fact is, most likely it is going to raise. Fed Funds Reserve is most likely going to raise rates by maybe 4 to 5 times this year because of inflation, to tame the inflation. So chances are it is going to go up. Now, what is going to happen if rates go up? What's going to happen with mortgage payment? Now, this is based on the typical median price home that we project for 2022. Now, with a 3%, the mortgage payment for someone who put down a 20% down payment will be $3,774. But what if it goes up by 50 basis point or 100 basis point? The number in red gives you an idea of how much it will increase in terms of mortgage payment. It's not a small amount. This is a monthly mortgage payment. If it goes up to 4%, for example, then every month a buyer will have to pay $373 more, and that amounts to a bigger number. And of course, that affects the lender qualifications and all that things. Take a look at again based on the survey number. Last year, most people who bought a home were able to lock in with a 3% mortgage rate. But even with that, with a price of close to 800,000, and here it's actually 705. That's including condo numbers. With the 3%, the household income for home buyers still amount to 150,000. Excuse me. Take a look at how this number compared to 2019 and 2018 before the pandemic. It actually increased by about 25% compared to the percentage of the household income in 2018, 2019. That's not a small amount. And for the Housing Affordability Index, that's the percent of households that can afford to buy a median price home, it actually dropped from 33 in 2020 to 23%. That's a significant drop. Excuse me. Now, let's take a look at how it compares historically. If you look at housing affordability, then the fourth quarter, we're actually are seeing some slight improvement. And the second quarter actually was the lowest. It actually improved in third, and then the fourth. And the fourth quarter of 2021, it was at 25%. Only 25% of all households in California can afford to buy a median price home. Take a look at how it compares to the historical number. At one point in 2009, of course, in 2009, home prices actually dipped to a very low level. It was actually 55%-ish or so. With interest rate rising in the first few weeks of the year, it is very likely that we will see an affordability level a little bit lower in the upcoming year. And buyers and sellers are sensing it as well. We had our surveys, and we actually just wrapped up the February the February's numbers. It actually came in a little bit sooner than we thought. We do a survey on Google and ask people whether it's a good time to buy and a good time to sell. And last month, 19% of those who responded said it is a good time to buy. That's a very small number. After we had 2 consecutive months of improvement at the end of last year, it actually dipped because of interest rates, probably. And it dipped actually, and there's a difference of 6% difference between last year and this year. What about those people who believe it's a good time to sell? That number stay at 74%, which is a very high number, the record high number, and it is about 15% higher, percentage points higher than the year before. Now, it's not a surprise, even though with some slight increase in interest rates, home prices remain very, very high, and the market remained pretty heated. So that's why sellers believe it's a good time to sell. Now, the question is whether they're really going to put their house up on the market. People think it's a good time to sell, but they don't necessarily put their house up on the market because sellers sometimes also, or most of the time, also turn out to be buyers. And if they don't believe it's a good time to buy right now, then they hold off on selling. Let's look at some regional numbers. I'm going to go through some Southern California, some LA, and then some local numbers. Now, for Southern California, it represents about 55% of all sales in the state level. So it's not a surprise to see that they follow a similar trend. Sales dipped by about 10% compared to a year ago. And as far as price, it actually is a little bit stronger compared to the state as a whole. It's improved by about 14%. Of course, supply remained very low at 1.8%, 1.8 months, and then it's only stayed on the market for less than 2 weeks. What about the individual county? These are individual county in the Southern California, and I'm showing you the month-to-month comparison and the year-over-year comparison. These are raw data, raw number. So it's not accounting for seasonality change, but take a look. On a year-over-year basis, month-to-month basis, it's always going to be 20-some%, 30% because of seasonality. But take a look at the year-over-year number. Even on a year-over-year basis, just like the state, it actually declined from a year ago because a year ago it was pretty strong. But take a look at which county actually dropped the most. Orange County, which has some high-end home, actually dipped a little bit more compared to the more affordable segments. The 4 more affordable segments include Riverside, San Bernardino, single-digit decline. LA is right in the middle at around 12%. So it declined about 12%. So it's not as bad as Orange County, but it's not as good as Riverside, San Bernardino. But if you look at the year as a whole, now we only have 1 month in 2022, but what about if you look at the year of 2021 compared to 2020? Now this is the 2021 number. It's actually pretty good, for all 5 counties. In 2021, LA actually exceeded each year for the last 5 years by a little bit compared to 2017, but it exceeded quite a bit compared to 18, 19, and 20. So not too bad. In fact, every single county except for San Bernardino exceeded their sales number for the last 5 years. San Bernardino was just below 2017 by a little bit, in 2021. So it's not too bad. The question again is, whether that momentum will carry forward. We are seeing some slowdown in momentum. As I mentioned, LA is not an exception. LA also dipped 11 or 12% compared to last year in terms of pending sales, in terms of open escrow sales. This again suggests that in the upcoming month, or before the end of this month, February, we are going to see some slowdown compared to the year before. But what exactly is this number? Now, a decline of 12% from previous years. Last year, for sales at the state level, for example, it actually was down at it was at around 460,000, for a seasonally adjusted number. So a 12% decline could be somewhere around a decline of close to 25,000-ish or so. So we're still looking at around 420, 430,000, in 420, more like 420 closed sales in February. Not bad, not bad. Now for LA, housing supply continued to struggle also, but you can also see some improvement. It is dipping, it continued to dip, but it actually dipped the smallest amount in the last 5 months. So hopefully we are going to see a little bit more positive improvement in supply in the upcoming month, in the upcoming year or so. Listings also fly off the shelf for LA, and for the time and market for Southern California as a region stay at around 12 days in January. And then another competitive measure, the percent of homes sold with a price above asking. For LA, it stays at 63%. Remember what the state number was? It was 57. So we're a little bit above the state number, and it still stays at a very, very high level above the pre-pandemic level. And as for price, your clients again want to know what the price level has been, how the price level has been doing. Look at at the beginning of the year, LA number, yes, is not as high as December, but it is an increase compared to a year ago by close to 14%. But take a look at how it compares to other counties. It is not the county with the highest increase. Orange County increased by more than 20%. Riverside, San Bernardino, and San Diego all increased more than LA. I think LA is growing, but it's not growing as fast, but it also means sales may not be dipping as much. And here's the 2021 compared to 2020. For the year as a whole, we saw an increase of 19% in LA. Other counties are doing a little bit faster, growing a little faster. For Orange, Riverside, San Bernardino, but San Diego and Ventura also increased, but not as much as LA. I have to show you this chart. This one is the housing affordability by county. I mentioned earlier, 25% of all homes, 25% of all households cannot afford to buy in California. LA is actually even worse, 21% only. So it's going to get worse in the upcoming year, unless you assume that the interest rates are going to go up. But unless you assume income is going to go up a little bit faster than interest rates or home prices, which I don't think is going to be the case. We are going to have a solid increase in household income overall, but maybe not as fast as inflation rate, or maybe not even as fast as the surge in interest rates. Now, what about individual cities? I put 8 cities in San Gabriel Valley that I think you might be interested in. It shows you the sales on a year-over-year basis, 2021 compared to 2020. And you can see the story. The story here is basically every single city has been showing some improvement, and most of them are improving by more than 10%. Acadia improving by 54%, San Marino increasing by 59% or so. It's a pretty good year in 2021. What about price? Price Also, at the same time, because of demand, because of low interest rates, continue to increase by double digit as well. San Marino has a median price at 2.5 million now, not just a 1 million, but 2.5 million. San Gabriel actually had a increase in median price. Now it's over a million. A few other cities have been showing, median. They have become $1 million city, except for Alhambra, Monterey Park, and Temple City. And Temple City is very close. And most of them are increasing by double digit, except for Temple City. Now, in the next few slides, these are slides that I've shown you before that you can actually download from the CR website. There's a dashboard called the Housing Market Overview. And I selected about 6 of them to show here that you can download and share with your clients. They come in PowerPoint format, they will come in Word document format, and PNG format. What you will see from these slides is they show you similar trend. Most median price continue to stay up. Supply, active listings continue to go down, and the sales actually varies between cities. Now for Alhambra, it actually dipped a little bit by 8.3% compared to a year ago. Acadia actually showed an increase in price and sales, and also supply also dipped. Same for Monterey Park, supply dip, but also median price increase. Pasadena with this 4% increase in sales, price increase close to 20%. Supply also declined. Take a look at the sales to list price ratio also. That is a number that shows you how competitive the markets are. And San Gabriel actually is very competitive, with people offering 10% above asking price. But again, dip in sales and dip in supply. I think this is the last one of all the individual county price snapshot. Dip in sales and dip in supply again, but look at the sales to list price ratio, increased by 11.2% above the asking. Now, part of the reason why we're seeing, some demand in, San Gabriel Valley is many of you are probably have the experience of dealing with international buyers. Now, in 2020, we had a very slow international buyers desire to buy. Well, part of it is not necessarily just desired. Part of it is because of the travel restrictions. Part of it is because of uncertainty about housing market. And part of it also is because of competition. So a lot of sales, actually, if you look at the survey data again, in 2020, the number of people who were considered international buyers actually dipped to the lowest level in the last 13, 14 years. If you look at the bounce back, though, in 2021, that number actually bounced back, meaning of all the shares, of all the sales, 4.6% of sales in California were purchased by international buyers. That's a bounce back, a pretty high number. But I believe this number right here, the 2021 number, is actually a pending demand that have been holding off in 2020. So you started seeing a little bit more international buyers buying in 2021 because of pent-up demand. 2022 probably will be a little bit slower in terms of share. Now, many of those are Chinese buyers, but they also have concerns at home, again, because of travel restrictions, because of the economy not growing as fast as before. And I believe, and don't quote me on it, I believe the Chinese housing market actually softened up a little bit, in the last 12 months or so. But many of them are many of the international buyers are still Chinese buyers. In fact, 1/3 of them were international. Were 1/3 of the international buyers were Chinese buyers. And it will continue to go to make up a big part of it in California, but it is not as high as 2018, definitely not as high as 2017. And based on the NAR statistics, these are statistics provided by NAR based on their survey. If you look at the next 12 months, what people expect, what realtors expect to be the international buyers activity in the next 12 months, they believe that in terms of number of people who will be actively involved in international buying, it will show an increase. 24% believe that we'll see some additional activities in the next 12 months or so. And but a lot of people actually still don't know. About 50, close to half of them didn't know whether that things are going to get better or not. But frankly, it's hard to predict because many of us predicted that COVID will be over by now. But of course, right now we're still, it's getting better. And I'll show you in a minute. It's getting better, but we're not completely out of the wood yet. So let's take a look at the economic conditions in the next 10 minutes or so before we talk about market update, before we talk about the outlook. So in the last couple of days, of course, last few days, we have been talking about, the Russia-Ukraine conflict. There could be, a bit of economic impact, but if you take a step back and look at the direct impact, Russia and Ukraine together, they actually do not make up a significant portion of the global economic activity. The conflict may result in maybe a 0.1% decline in economic activity at the global level. But if you just look at the economic activity that they'll cut back. But what happened is the more concerning things is on the indirect impact, the indirect economic impact that Russia-Ukraine conflict could result in. You might have already heard on the news that it will lead to higher gas prices, higher oil prices, because Russia is actually the third largest oil production company behind U.S. and Siberia, Southern Arabia. And so it's going to lead to a supply constraint in the oil market. Now, not necessarily in the U.S., because we actually produce enough to supply on our own, but it's going to affect the global market. And oil prices will rise, and that will lead to energy prices being a little bit higher. And energy prices being a little higher, that will also lead to higher inflation, which is something that we have been, trying to combat with. What the economy has been concerned about. Many people are concerned about inflation, but it's not only oil prices, other energy prices. Plus, I think Ukraine and Russia, they produce a lot of wheat, and that could actually lead to food prices being a little bit higher, and that could lead to more inflation. Now, inflation has been a concern for the last few months. It was on top. It was at like 7.5% for the CPI that was released last month. That number was supposed to start coming back down, but with energy prices being a little bit higher, it is possible that it may actually stay elevated for a little bit. And that concerns not only consumers, but it concerns the stock market. Some of you probably have been paying attention to the stock market. You probably realized this morning, before I went on on Zoom, I noticed that as far as the stock market is concerned, it's getting a little volatile. It actually came down a little bit as far as the indices are concerned. And it has been pretty volatile in the last few days, last couple of weeks or so. Part of it is because of inflation. Part of it is because of the concerns about, what the Russia-Ukraine conflict is going to bring to the economy. That, financial market turbulence will lead to less wealth. People feel less wealthy, and they may actually spend less. But the other concern that people have is it is going to lead to high inflation, possibly, and what is going to happen to interest rate. Now, it's a little bit of a conflict. On one hand, when you have energy prices being higher, you have high inflation, and interest rate could potentially get higher. But at the same time, if it affects the economy, then the economic growth will actually not be as high, and that could lead to interest rates not rising as fast. Now, how it's going to pan out, we'll have to see. But slower economic growth is very possible. So far, though, we actually have been doing okay. Now, I'll show you in the next slide. Part of the reason why we're actually a little bit more optimistic is because of the COVID situation. At the beginning of the year, we had a significant surge in number of cases. This is the end of last year, and then the surge in the first couple weeks or so in terms of number of cases because of Omicron spreading. It's spreading really fast. Look at this number. This number is 3 times higher than what we were at a year ago when we had the spread. But at the same time, it quickly came down because Omicron is not as severe as the Delta variant, as well as the COVID cases that we had a year ago. So it has been coming down, which is a great sign that things are coming back to normal. In fact, for LA, we are lifting the outdoor mandate, the mask mandate for school today, and there might be some more mandate being lifted indoor if things get better. Now, positivity rate is another indicator that shows things are getting a little bit better. The number actually came back down to 3.6%. At one point, just a few weeks ago, it was above 20%. And the number of people who have been hospitalized actually started coming back down also. With COVID situation improving, that means we will have a little bit more activities, economic activity, because people will be going out to eat, people will be going out to stores. And so that improves the economic activity. And we are seeing some improvement at the beginning of this year. Now, after things dropped at the end of last year, take a look at the retail sales number here. The very first line here, it shows the month-to-month percent change. At the end of last year, we had a drop. We had the first drop since I think July on a month-to-month basis. Part of it is because of supply constraint. Part of it is because of inflation. Part of it could be because of COVID. But things bounce back. Surprisingly, I actually did not expect this number, the January's numbers, to be at close to 4%. I thought it might actually improve by about 1%, 2%, but not a 4%. So that's encouraging. And if you look at how it compares to a year ago or to the pre-pandemic level, this is the pre-pandemic level, things are actually improving. Retail sales have been improving by double digit. So that's encouraging also. With retail sales actually bouncing back, things are looking up a little bit. But it also depends on whether consumers believe things are going to improve. The number shows that it is in terms of retail sales, but consumers are concerned. Consumer confidence, in fact, actually down slightly compared to last month, very, very slightly. Now, when we break down the consumer confidence, we see a couple of things. One is the present situations, what they think about the present situation, what they think about the short-term aspects. The current situations, they actually have improved a little bit. But the short-term expectation is still a little bit iffy. Yeah, it's actually came down. And some of the consumer confidence survey data also suggests that in the next few months, people might be actually less reluctant to buy home. And that partly is because of increase in interest rates. And whether that is going to have a direct impact, we'll find out. I mean, consumer sometimes could be saying something and doing something completely different. So we'll find out. But as far as the quarterly number, the GDP, economic activity numbers are concerned, fourth quarter was strong. I was concerned about the chart on the right-hand side, though. When it was strong in the fourth quarter, take a look at the amount of the increase that was due to. On the right-hand side, it shows you that inventory made up the biggest portion of that 6.9 increase that we saw in the fourth quarter. That 6.9% was pretty impressive because typically in a normal economy, it should grow by about 3%, 4% or so. So 6.9 was pretty impressive. But if you look at the chart on the right-hand side, you'll notice the darker blue color suggests that of that 6.9%, most of those increase was due to inventory. Companies, stores building up inventory so that they can actually sell more because they're concerned about supply constraints also, not just consumers. My worry was if at the beginning of this year we're not selling as well, then those inventory will build up. Those stores and companies will not be buying as much, so it's going to lower the economic activity in the first quarter. But with January's numbers showing up as a pretty strong number, that might show that the first quarter is going to be decent. Now, when I say decent, it's not going to be as strong as the 6.9% that we saw in the fourth quarter, but it may be actually a 3% increase or 4% increase. So we'll find out. Now, the other indicator that you can look at is the labor market. That's something that affects our pocket. If someone is employed, we have money, we can spend. Now, we dropped a significant number of jobs when we had a shutdown. It dropped by about 2.7 million, and then slowly we recovered the number of jobs. But at the end of last year, we were still down by about 770,000 in California. And if we use the number projected by the trend line, we would actually be short another 570, which means we are short by about 1.3 million jobs. Now, is that because people couldn't find a job, or is it because other reasons? Take a look at the chart on the right-hand side. Job opening actually has been at a high level. In fact, it has been at the highest level for the last maybe 8 or 7 years. So there have been a lot of job openings out there. But the problem is labor shortage. Now, during the pandemic, this is right during a shutdown. During the pandemic, at the beginning of the pandemic, more than 50% of people not in the labor force who want a job were not able to find a job, because of the shutdown, because of the service sectors being affected the most. But that number has already come down to a lower level below 10%. So it doesn't explain all the labor shortage that we're seeing right now. But the other part of it is people who are retiring, who retired earlier. Take a look at the survey done each year for the last 3 years or so. For the 55 plus in 2019, the number was a little bit lower. I shouldn't say much. It was a little bit lower than what we recorded at the beginning in 2021. Now, let me show you another slide. Take a look at this slide. This is a slide that shows you the percent of people who retired going back to 2009. The percent started climbing because of demographic changes, but it has been pretty stable. Now, if we didn't have the pandemic, we should be at this rate right now. But the pandemic caused a shutdown. Many people decided to retire earlier. That number never came back down to this level. This number actually dipped a little bit, but it actually stayed at a higher level now. So that means that many people might have retired earlier. Now, it could be because of concerns about COVID. It could be because of the financial market doing a little bit better. So many people retired earlier, and that's one of the reasons why we're seeing labor supply shortage. Labor supply shortage contributed to wage growth, but at the same time, we also have material shortage as well. There was a survey done throughout the last, 8-9 years or so, asking whether shortage of material and equipment will limit production. And it has been consistently stay at, below 20%. But after the pandemic, or since the pandemic, or specifically since the beginning of 2021, that number has gone up significantly. So material shortage, equipment, cause delay in production. That will delay in productions cause supply disruptions. That will actually lead to products being priced a little bit higher. Now, how long is that going to last? If you look at another survey done on U.S. corporations, many of the firms, many of the corporate executives believe the supply disruptions situation will continue to be here until second quarter. We'll continue to see production delay. We'll continue to see shipping delay in the second quarter. And it is probably not until after 2022 that we started seeing most people believe that supply disruption will go away. So that means what? Inflation is going to continue to stay at a high level. Now, previously, before the Russia-Ukraine conflict, UCLA predicted that last quarter, fourth quarter of 2021 will be the peak of the inflation, and then it will continue to go down. But with the conflict, it is possible that the decline may be a little delay, or maybe the magnitude of decline may actually be a little bit smaller. So inflation may stick around a little bit, and that's important to us because we know that affects interest rates. Economy will continue to grow though. It is probably going to go back to the trend line at the end of the 2022. So economic growth will still be there. And this is what we predict as far as economic growth. And I'll have about 5 minutes to talk about the market outlook. The economic outlook, we expect a close to 4% increase in 2022 as far as the economy is concerned. Unemployment, it will dip below 4%. Now, that is important because before the pandemic, we were right around 4% or below 4%. So we will be going back to the pre-pandemic level. That's encouraging. But at the same time, look at CPI, this fourth row here. CPI, which is an indication for inflation, will be at 4.3% this year for the average. Typically, it's at 2%, below 2% at some point in the last 5 years or so. So the fact that it will stay above 4% means we will still have inflation. For California, it might actually grow a little faster because we have been restricted by traveling restrictions, people not being able to come here because of COVID. Things are going to look a little bit better with unemployment being down to below 6% for the year as a whole, and we will continue to grow in jobs by 4%. What about the market? Now, I am optimistic about the market partly because of the fact that many people will be turning to the age of home buying or establishing their households. Take a look at this segment right here, the one in orange. That's each bar represents the number of people in each age group. This is by age group, from age 1 through age 99. For those people who turn age 26 and age 34, that's a lot of people here. In fact, that's the largest group compared to this portion and maybe this portion for the same number of years. So that means we do have the need of finding a home or buying a home. Many of those will be first-time buyers though. In fact, about 35%, 36% last year who bought a home were first-time buyers. So it will continue to make up a very big chunk of it. And first-time buyers face affordability issues more so than the repeat buyers because they don't have equity built up. And first-time buyers, the household income last year was already at 6-figure for someone who purchased a home for the first time, and they needed a $50,000 median down payment. So it's going to be tough for first-time buyers, and that's the challenge. Now, so far for the last few weeks, even though we have been seeing high interest rates, but look at the mortgage applications. Purchase mortgage applications for not for refinance, but for new homes sold. This is the line that shows you the trend compared to other years. Now, compared to 2020, it's still below 20. Compared to 2021, it's still below 2021 level. Most likely, it will continue to stay below 2021 level. But take a look at how it compares to 2020, 2017, 18, and 19. It's above those years. So that means we are going to continue to see, at least for the next month or so, most likely we'll see closed sales a little bit above. The concern again is supply. These are the structural issues. This is how many homes we expected to build this year in 2022 based on permits. That's how many we need normally in a year. We're still short about 60,000, 63,000, even though we're building a little bit more compared to a year ago. And what about people putting their house up on the market? Because of demographic reasons, older people don't usually turn over their house or sell their house as often. The last few years, we have been seeing people staying at their house for 11 years before selling. Now, whether that is going to continue on, it's hard to say. The affordability issues will continue, and that might actually force some people to move out of California, which is not what we want to see. Last year, based on the survey, 35% of the sellers who sold decided to move out of California. That's actually the highest that we have seen, at least the last 16 years or so. Whether that is going to continue, that's hard to say. The flexibility of working from home allows people to move. That's one reason, but also interest rates being higher is another. Now, you might want to ask about prices. What are we going to see? What can we expect about prices? And you might be surprised that I'm showing a sales slide instead of a price slide. Take a look. This is the share of sales to all sales by price range. The green line is the high-end homes, which is homes above $1 million. The blue line right here are homes sold with a price below 500. When we talk about median price, a lot of time, we have to look at the mix of sales. If we have more high-end home being sold, then we would have a higher median price. Take a look at this green line. It actually has been increasing until maybe mid of 2021, and that number actually started coming down. So from that point on, we actually have smaller share of high-end homes or above $1 million home being sold. Part of it is because of some weakness in the Bay Area, maybe in Santa Barbara or so. So if that trend continues, if we don't continue to see increase in the mix of sales and high-end home, that means the statewide median is going to come down a little bit. Now, for individual homes, it may not depreciate or not grow as much. I shouldn't say use the word depreciate because it is going to continue to grow, but at a more moderate rate. And we're already seeing some increase, small slow growth in price. Since May, like I said, we have been seeing some slowdown. 9.4% is the kickoff of the year. 2022, it started off with a 9.4%. Now I can tell you this, based on some numbers crunching that I did, for the first 2-3 months of this year, you will continue to see 8 or 9% increase in price, in the statewide median price. Starting in April, starting in May, you might see a little bit more moderations, maybe 3 or 4% instead of 9%. So just to kind of prepare you for the slowdown. Now here's our predictions. With the prices remaining at a high level, we believe that overall this year, it is going to grow by 5.2%. Not too bad. Of course, it is not going to be as high as what we saw last year at 19 and not as high as 2020 at 11, but it's still a pretty decent improvement from the year ago. The sales part, the sales or demand is going to dip a little bit because of supply, because of interest rates, and because of housing affordability. Affordability is going to dip a little bit. Take a look at the 30-year fixed rate. Right now, for the year as a whole, for the average, we predict that's going to be 3.8%. It might actually be, we might have to actually adjust this a little bit higher because of how fast the rates have been moving. With that said, here are the bullet points that kind of summarize everything. Demand again is going to remain pretty solid, by historical standard. We are going to see a little bit of a slowdown in sales, but it's still at a pretty high level. And part of it is because of tight supply. Part of it is because of increase in prices. We do expect prices to continue to grow at a more moderate level at about 5%, because we do believe that economy is going to continue to recover in 2022. Maybe not as fast as what we saw in 2021 though. And the other factor is rates. Interest rates, they're going to go a little higher. Part of it is because of inflation, but part of it is because of uncertainty. And COVID is still going to be the wild card, but I think it's probably going to get better and better after this month or so. And with that, I want to thank you everyone for listening. Here's my email address, and this presentation will be posted on the CR website as well, but I will send that to Pauline and to Fong, and feel free again to share that with everyone. And I don't know whether I have enough time for Q&A, but I'll leave it up to you guys.
Yeah, I think thank you so much, Oscar. That was an amazing presentation as always. We did have just 2 to 3 questions. Let's get them in. This one's from our Tenza Ramirez. What percentage of homes are being purchased by investors versus owner-occupied buyers?
Good questions. I normally have a slide, but I don't have a slide this time because I have too many slides to include. Now, in terms of the percent of investor share, investors typically, I'm not talking about 2020 or 2021 right now, typically for investors, now that includes investors who flip homes as well as buying for rental. Typically that's about 16-17%, in a typical year. In 2020, because of the shutdown, because of concerns about what's going on with the market, and because of the concern about rental market, that number actually dipped to about 9%, I believe. It bounced back in 2021, but it's still below the norm of 16-17. I think it bounced back to about 13%, 14% or so. The mortgage moratorium, concern about renters not being able to pay rent was the concern. But I think in 2022, you will see more people coming back. You already know the rental market as far as average rent is concerned, it has actually gone up. I think Zillow released a report saying that average rent might have gone up by 8 or 9% in LA and some other areas. So you will probably see investors coming back. The other questions that I can't really answer is how many of those are institutional investors versus independent investors. That one is a little tricky to answer because I think institutional buyers actually have been buying outside of California. Many of the investors buyers in California, they probably are mom and pops.
Thank you, thank you, Oscar. And this next question is from Mr. Lee. His question is, again, thank you for the presentation. So with, the Fed Reserve is trying to combat inflation and using the rate hike as a tool. In the meantime, our earning power has not kept up despite the lack of manpower in the labor force. Banks may have a tough time finding qualified buyers. So do you think the housing price will tame down a little bit to reflect the local sentiments of a slower market in the later years?
It definitely will be, as I mentioned. At the beginning of the year, right now we're still seeing 8 or 9%, right? But as I mentioned, the home prices are going to slow down a little bit to 3 or 4%. It may actually even go down. Now, I couldn't guarantee you that, but I think there is at some point we may actually see in one of the months a slight decline compared to a year ago. So it is very possible. It really depends on how fast rates will be going. Now, right now, I will be honest, the 4%, 4.1 or 4.25% as compared to before, it is still a very low level compared to historical data. But the thing is, when you have increase in price combined with increase in rates, I show you that mortgage payment has increased by about 15% for a typical typical home. So yes, I think competition will likely be slowing a little bit. There might be some uncertainty also. I do not believe household income is going to grow as fast as inflation, at least not in the first half of the year. But you can also see that as far as household income is concerned, it is actually rising a little bit better compared to a year to 2 years ago because of the tight labor market that I mentioned earlier. I don't think first, when we see before we see price appreciation slowing, you will also see some slowdown in sales as well. And right now we are still seeing decent demand in sales. It is part of the reason why we're seeing some slowdown is because of supply. So I think we will most likely see some improvement in supply before seeing some slowdown in price growth, and then you'll start seeing some demand slowing down as well. So that will give you some signal of how much price growth is going to slow down. But I still believe that this year it's going to be a mild 3 or 4%. I'm not as optimistic as some of the other economists who believe it's going to be a double-digit growth. I think that time has passed.
Thank you, Oscar. Well, with that, let's start wrapping up. Let's start wrapping up. That concludes our Q&A session. On behalf of West San Gabriel Valley Realtors, we would like to thank Oscar Wei, Deputy Chief Economist of California Association of Realtors, for being our guest speaker today, and for your informative presentation.
Thank you.
Next, we have an amazing lineup of useful and interesting upcoming classes. On March 1st, we're having a real estate legal update presented by Paul Chang. March 8th, a commercial seminar, Tax Issues Affecting U.S. Property Investing by Howard Lee. And on March 15th, a Meet and Learn, Typical Title Clearance Problem by Nancy Chan. We hope to see you there. Till then, thank you. Goodbye.